Today, we are diving deep into legendary investor Howard Marks' core philosophy, this amazing framework he calls second-level thinking. It is, no joke, the secret to getting past just average returns and actually gaining a real edge in the market.
But first, we gotta ask the big question. Why is it so incredibly hard to outperform the market? I mean, think about it. You're up against millions of really smart, super motivated people. If you're using the exact same playbook they are, how can you possibly expect a different result? It just doesn't add up.
You know, the reason most people fail is because they're stuck in what Marx calls first-level thinking. It's pretty simplistic. It's superficial. It's seeing something that looks good on the surface, a great company, a rosy economic forecast, and immediately jumping to buy. It's the most common way to think, and honestly, it's a recipe for being just plain average.
I mean, just think it through for a second. If millions and millions of investors are all using that same simple logic, their actions basically guarantee that any obvious good news is already baked into the price. So, by definition, you just cannot get above average results by thinking like the average investor. It's impossible. So, what's the antidote here? What's the fix? Well, the path to truly superior results demands something more. It requires a deeper, way more rigorous approach. And that, my friends, is called second-level thinking. Let's look at how these two mindsets really stack up. A first-level thinker, they see a good company and they just buy. The second-level thinker goes, yeah, okay, it's a good company, but everybody knows that, which means it's way overpriced. This is actually a sell. Or when the outlook is terrible, they don't join the panic selling. No, they see a potential buying opportunity. See the difference? It's deeper, it's more complex, and a lot of the time it's about going against the grain.
And this isn't some simple buy or sell checklist. Oh no. A second-level thinker is asking a whole different set of questions, and they're way more demanding. Stuff like, what does everyone else think is going to happen? Okay, how is my view different? Is the current price reflecting way too much optimism, or is it reflecting total pessimism? It's not just about trying to predict the future. It's about understanding what expectations are already out there right now. In short, they're thinking about thinking. So how do we actually put this stuff into practice? Well, it all starts with the very first pillar of second-level thinking, getting a deep, profound understanding that the quality of an asset and the price you pay for it are two totally different things.
And here's the absolute key. Your success isn't decided by what you buy, but by the price you pay. A fantastic asset can be a truly terrible investment if you overpay for it. And on the flip side, a kind of mediocre asset can be a brilliant investment if you snag it at a bargain price. There's no better example of this than the Nifty 50 disaster. Back in the early 70s, investors just piled into 50 of America's best can't-miss companies. They paid absolutely absurd prices for them, like 80 to 90 times their earnings. They thought quality was the only thing that mattered. But guess what? When those valuations finally came back down to earth, these great companies handed investors staggering 90% losses. They bought good things, sure, but they definitely did not buy it on low.
You know, Warren Buffett puts it perfectly. The goal is super simple. Find something that's really worth $1 and then figure out how to buy it for 50 cents. So the big takeaway from this first pillar is huge. Stop asking, is this a good company? And start asking, is this a good price? That one mental shift, it changes everything.
Okay, so this intense focus on price leads us right into the second pillar, because second-level thinkers don't just see value differently, they have a completely different take on what risk actually is. If you go to business school, they'll tell you risk is volatility. You know, how much a price bounces up and down. But for a real-world investor, that's not what keeps you up at night. The real risk, the one that truly matters, is the possibility of permanent loss. It's the chance you put your money into something and you just don't get it back. And here's the crazy paradox. The biggest risk isn't hiding in scary headlines or weak companies. No, it shows up when everyone is optimistic and prices are sky high. When everybody believes there's zero risk, that is precisely when the environment is most dangerous, because those high prices have already wiped out any real potential for a reward. And that's the lesson. The time to be most careful is when everyone else is euphoric. The real risk isn't in the scary story, it's hidden in the price tag. And all of this brings us right to our third and final pillar, understanding that markets are not driven by cold, hard logic. Nope, they're driven by human emotion that swings back and forth like a giant pendulum. Howard Marks uses this awesome analogy of a pendulum to describe market sentiment. It's just constantly swinging between euphoria and depression, between total greed and paralyzing fear. But here's the key part. It spends very, very little time at that sensible, happy medium in the middle. It's almost always moving toward one of the extremes.
So at one extreme, you've got greed. Optimism is everywhere, and that fear of missing out, FOMO, pushes prices up to really dangerous levels. Then, at the other extreme, you've got fear. Pessimism completely takes over, and assets get dumped without a second thought, which is what creates incredible bargain opportunities. This old saying just captures the cycle perfectly. The second-level thinker, the wise investor, they see the very early signs of a recovery, and they act. The first-level thinker, the fool, well, they ignore it until the gains are obvious to everyone. And then they pile in at the absolute peak of optimism, which is, of course, the most dangerous time. So the big insight here is that you have to be an objective observer of all this emotion, not a participant in it. Your job is to take advantage of the pendulum swings, not get swept away by them. So after all that, what's the big takeaway? Well, when you put these three pillars together, distinguishing price from value, understanding what real risk is, and mastering market psychology, you get a very clear path to achieving truly superior results. Look at it like this. If your behavior is conventional, if you're just doing what everyone else is doing, you're going to get conventional results. Sometimes good, sometimes bad, but always average. The only way to get above average extraordinary results is to behave unconventionally and be right. Both parts are critical. And that's really the bottom line, isn't it? Superior performance is, by its very definition, different. It demands a different process, a different way of thinking, and a totally different set of actions than what the crowd is doing. It absolutely requires second-level thinking. And that leaves us with one final, pretty tough question to ask ourselves. To beat the market, you have to have a unique point of view that turns out to be more right than the consensus. You have to be different, and you have to be better. So, what makes you think you are?